Gas prices literally just hit a 4-year high, and the U.S. has just fired on oil tankers in the Middle East. Welcome to The Explainer, everyone. Today we're unpacking a massive structural shift that's underway in the 2026 global energy market. We're looking at a market that is completely defined by a persistent military and administrative stalemate in the Strait of Hormuz. We're rapidly moving away from traditional supply and demand fundamentals and diving headfirst into what we call geopolitical arbitrage.
Look, this quote really hits the nail on the head regarding the predicament investors are facing right now. If you're not hedged for $120 oil, your portfolio is a hostage to the Strait of Hormuz. It's that simple. Relying purely on traditional equity exposure right now, that leaves your capital completely at the mercy of the kinetic military reality in the Middle East. If you're unhedged, you aren't just sitting on the sidelines. You are actively taking on systemic risk.
So, here's our game plan. We're going to systematic break down exactly how professionals are navigating this. We'll start with the Hormuz stalemate reality, look at the retail directional trap, dive into the volatility disconnect, reveal the one-chart strategy pros use, set up some geopolitical insurance with XLE, and finally, map out the stalemate endgame.
All right, part 1, the Hormuz stalemate reality and the kinetic breakdown. We've got to define the physical disruption first. 12.4 million barrels per day. Just let that number sink in for a second. This massive figure is the daily production deficit caused by the current maritime blockade, which is forcing these collective production cuts among Gulf nations. But here's what you really need to take away. This is not just about expensive gas for your car. In our modern macro framework, this represents a massive, sudden withdrawal of collateral from the entire global financial system. Think of global dollar liquidity like a giant, complex engine. Physical oil is literally the lubrication in that engine, because oil is traded in dollars. So when you yank 12.4 million barrels a day off the market, you create this systemic liquidity gap that reverberates straight through the offshore banking system. It creates a massive tightening effect, even if central banks sit on their hands and do absolutely nothing.
And you can really see this headline whiplash playing out on this timeline from early 2026. Look at this. Late February, airstrikes commence, pushing Brent crude right toward $100. Then, fast forward to mid-April, suddenly there are rumors of a ceasefire. Prices drop, everyone breathes a sigh of relief, thinking it's over. But then, bam! May 4th, missiles are fired in the strait. May 8th, U.S. forces actually fire on and disable 2 Iranian tankers trying to breach the blockade. The diplomatic peace rumors are constantly contradicting the actual escalating military engagements on the ground. And retail investors, they inevitably get chopped up trying to trade these headlines, right? Buying the spikes, selling the dips, at literally the exact wrong times.
Which brings us right to part 2, the retail directional trap. This is really about amateurs versus professionals. Here is the brutal truth of the markets during an energy shock. Amateurs react while professionals anticipate. Your typical retail trader watches the evening news, sees a report about an attack, and immediately goes to blindly buy the USO ETF, or maybe they chase big integrated oil majors like Exxon right at the very top of a price spike. But institutional players, they are completely abandoning straight stock picks for derivative hedging. They're buying volatility, they're exploiting the futures curve, and they're using out-of-the-money calls. Why? Because the equity values of those oil companies are actually capped by broader market sell-offs. Think about it. If oil spikes to $150, inflation reignites, and that causes a broader market crash. That macro crash is going to drag down Exxon's stock price no matter how much cash they're printing from expensive oil. So, amateurs buy the stock, professionals buy the mechanics.
And speaking of mechanics, this dynamic perfectly explains the massive hidden losses retail traders suffer when they use the USO ETF. It's a concept called contango. See, USO holds expiring paper contracts. They don't have physical barrels of oil sitting in a warehouse somewhere. So they're forced to act like a tenant who has to constantly renew a short-term lease at higher and higher prices. Every single month, as their current contract is about to expire, the fund has to sell it and buy the next month's contract. If those later months are more expensive, they are mechanically forced to sell low and buy high. In 2026, this structural flaw hit retail traders with a 15 to 20% hidden tax through this negative roll yield, meaning they were actually losing money while the physical price of oil was going up. Crazy, right? But when the market flips into what we call extreme backwardation, the rules totally change. This happens when immediate spot prices are significantly higher than future delivery prices. It indicates an absolute, desperate scramble for physical supply today so refiners can keep their operations running. In May 2026, the front-month contract traded at a massive $12 premium over the September contract. Professionals use this curve shape to extract mechanical profit via positive roll yield.
They are essentially getting paid to roll their contracts forward into cheaper, deferred months. They can profit even if the actual spot price of oil doesn't move a single cent. Okay, part 3. Let's look at trading the volatility disconnect. This is the alpha gap. Now take a really close look at this data, because we are witnessing a historic disconnect here. The VIX, the fear gauge for the broader stock market, is sitting calmly right around 1991. Equity investors feel completely safe because massive AI growth and tech earnings are just propping up the S&P 500. It's totally masking the underlying risk. But if you glance over at the OVX, the crude oil volatility index, it is absolutely screaming, sitting in the top 4% of its historical range. This creates an extreme volatility ratio of greater than 4.0. The equity market is sleepwalking, entirely absorbed in AI hype, while the oil market is pricing in catastrophic tail risks and kinetic military actions. So, what do the pros do with this disconnect? They actively buy low-cost volatility during temporary diplomatic lulls. When the headlines hint that, oh, peace talks are progressing in Islamabad, the overall volatility drops and option premiums get incredibly cheap. But smart money knows the physical blockade of over 1,500 stranded vessels is a structural reality, not just a diplomatic talking point. They know these peace restatements are traps, so they scoop up this cheap volatility during the quiet periods as a deeply discounted hedge against the inevitable shootout in the Strait. Basically, they're buying fire insurance while the whole neighborhood thinks the fire's already put out, because they know the embers are still burning. Moving right along to part 4, the one-chart strategy. This is all about anticipation, not confirmation. And here it is. This is the essence of stalemate arbitrage, the exact predictive metric professional desks use to front-run the evening news. By using sentiment analysis, the data definitively proves that a 20% surge in news mentions of Hormuz reliably predicts a highly profitable 3 to 5% jump in WTI crude within just a 12-hour window. It is entirely mechanical. While retail traders are sitting around waiting for the evening broadcast to confirm that a peace plan broke down, algorithms and pro traders are already processed the news volume and position themselves for a volatility spike. They trade the anticipation of the move based on data density, not the delayed confirmation of a news anchor reading a teleprompter.
All right, part 5, let's get tactical. Geopolitical insurance with XLE. How do we actually put this into practice?
Well, here is the multi-million-dollar question. How do you hedge a structural move to $150 Brent crude without dragging down your portfolio? Because if you just sell all your big tech winners to sit in defensive cash, you're going to miss out on the AI rally entirely. It's absolutely essential to protect your capital from the worst-case geopolitical scenario without paying an arm and a leg for the privilege of holding that insurance policy. So, here's the exact setup the pros use. Step 1, select the XLE ETF. This holds the major U.S. energy producers, which act as a natural, insulated hedge against Middle East supply shocks. Step 2, pick options with a 60 to 90-day expiration. This gives the geopolitical thesis enough time to actually play out without forcing you into ultra-short-term gambles. Step 3, target is 0.25 to 0.40 delta. Why? Because this is the statistical sweet spot. Delta measures the probability of your option expiring in the money. A 0.25 delta means it's cheap enough to act as insurance, but responsive enough to actually move when the underlying asset spikes. And step 4, choose out-of-the-money strikes, specifically in that $57 to $60 range. When you buy further out of the money, you're literally paying pennies on the dollar. By structuring it this way, you capture the explosive upside, the gamma, if the situation flares up. At the same time, this structure keeps the options cheap enough that the daily time decay, the theta, doesn't bleed your account dry while you wait. Maximum leverage, strictly capped downside.
Okay, part 6, the stalemate endgame. Let's look at the scenarios for late 2026.
With our hedges in place, market participants are actively pricing in 3 potential resolutions for the second half of the year. First up, the base case, a frozen conflict equilibrium. The waterway remains highly constrained, but not totally blocked, keeping Brent stubbornly between $100 and $120. Then there's the bullish tail risk. This is exactly what we just hedged for, a kinetic full closure. A catastrophic event removing 20 million barrels a day from the global market, sending Brent rocketing over $150. And finally, the bearish outlier, a negotiated Islamabad resolution, where an unexpected, total diplomatic de-escalation causes a rapid $20 to $30 price collapse as that massive war premium evaporates. Understanding these 3 distinct outcomes means you can use the derivatives toolkit we just covered to make sure your portfolio thrives no matter what happens geopolitically.
So I'll leave you with this question. Are you still trading the confirmation of old news, reacting after the spikes have already happened? Or are you ready to start trading the anticipation? As long as firefights continue in the Gulf and ships remain stranded in the Strait of Hormuz, the only truly expensive trade right now is remaining completely unhedged. Take a hard look at your portfolio today. Is it really prepared for tomorrow's headline?